All right, well, good morning, everyone. Good afternoon if you're on the East Coast. Welcome to today's, we can call it a masterclass because we're really going to dive into a bunch of different types of investing. Those that we saw were really, really strong last year in 2022. When people were kind of scared, Dave and I didn't hold back. We dove in, our companies dove in. We made some great investments. We had some great exits for our investors. And then moving into 2023, we're going to talk about what we're doing, what we see is the landscape, and what remains as really strong investments, what investments maybe aren't going to be as strong in 2023 for you guys, and then how you can find those, access those, and learn more about those. So Dave, I'll let you start by, actually, I'll introduce you and then let you introduce yourself as well. But for those of you who are invited here from Zook Capital, hello to all of you. And I want to let you know that I have been watching Dave / known Dave for maybe 3 years now. And I have a cash flow fund that is invested in some of Dave's offerings, some of his investments that his company has. And so I say that because I don't just bring anyone on to talk to you guys about investing. I have done due diligence for years on Dave, his company, his investments. And so Zook Capital has invested millions into Dave's company, into his investments, those things that I'm not an operator for. I'm an operator for certain things, but not all things. And so in my conglomerate fund, we've invested with Dave in his high cash flow investments to balance some things out for investors. So I say that to really let you know he is fantastic. He's really well known in the investment community. It's not a huge space with syndicators and fund managers. He has a great reputation, and everything that we have invested in has been spot on, exactly as projected as far as returns and all that good stuff. So he has a really great team behind him. So with that, I'll hand it over to you, Dave, to do an introduction, and I'll say thanks for being here.
Well, thank you, Sarah. Thank you for your partnership over the years, and I know we've enjoyed working with you. My team's enjoyed working with you, and you mentioned my team right at the end, and I could probably shine a bigger spotlight on them because you are 100% correct. They make me look good. So, and I tell them that, and so I got a great team, and we've been having a lot of fun. I'll get into a little bit of my story, but I feel like I'm doing my life's work. I mean, I love doing deals. I'm an investor and entrepreneur at heart. I love people, and so to be able to work with both and be in that space and help people solve problems is what I love doing, and I probably will do this for the rest of my life. And so I don't see this as work. This is what I love doing. And so just it's been a pleasure working with you and your team over the years, and I'm just excited about today. I look forward to hanging out with you and your group here for the next hour or two. So if you do you have my slides? Can you pull up my slides?
Yes. Well, I'll let me just let everyone know kind of the structure for today, and then I'll hand it over to you, and you can drive for your slides.
Whenever you're ready, you can pull them up there. I have sort of a story behind the story, and I kind of want to, I want to touch on tax because that's sort of how my investment story began. I had a tax problem, so I'm going to touch on tax first, and then go into some investment asset classes that I like, and that's all going to kind of come into the story because many times I make an investment that has to do with not only building wealth and building cash flow streams and all that, but also living a tax efficient life is what I teach. And so we'll get into that when you're ready.
Yeah, definitely. All right. So for everyone who's on here, welcome. If you guys don't know me, I'll do a quick introduction for myself as well. People always ask, is this being recorded? Will I get a recording? Yes, it's being recorded. We'll send it out to all the registrants, all 700 of you will get a copy. And also, by signing up for this, you're on the email list for the Real Asset Investor and for Sugo Capital. So you'll continue to get emails from us. It'll be really easy for you to get in contact with us going forward. So logistics of today, I'm going to do a quick presentation, and then I'll pass it over to Dave. So I would like to ask a question. Who here, and just put it in the chat, say yes, if you have invested in a private placement, so a non-public investment, put it in the chat. If you have, I'm just gonna move my camera to see the chat. If you have invested in a private placement, it's a non-public, right. You got a lot of people. Okay, cool.
Everybody.
Everyone. All right, awesome. Okay, beautiful. Thank you. So what we're going to do today is we're going to talk about what the wealthy do to earn more, to keep more, like Dave said, the tax side of things, and to grow more. So we're going to talk about the top 5, excuse me, I'm just going to go to this slide. Top 5 ways to make money in real estate, according to Dave and Sarah. There are over 15 ways to make money in real estate. And there's so many ways to invest in private offerings. And we're going to talk about our favorite 5 that have been performing well over the last couple of years and that we expect to be really strong given the uncertainty we see in our future. With those, we're going to talk about how to double your money with no work, and Dave's going to talk about how to double your money without paying taxes on that. And then he's going to pass it back to me, and I'm going to talk about investment structures. So if these types of investments sound good to you, you want to understand how they're structured. So when you go out and look at them, you understand what's being offered to you, whether it's Dave, myself, or someone else you find in the private space. So it sounds like a lot of you said yes, you've already invested in private investments. They are all the PPMs are written differently. So some key things to look at when you're looking at investment structures, I'll hit on that towards the end. So I'm going to back up a little. Who is Sugo Capital? So for those of you who are just meeting me for the first time, we connect investors to passive income opportunities. And so our average returns have been about 33% annualized for investors on things that we've exited. This number 22 properties acquired, it's now up to 24 because of the 2 that we closed in December of last year. We just haven't updated the slide. And much like Dave, my passion is connecting investors to opportunities that are good for them. And so my story is that I started investing in things like what Dave offers while I had a W-2 job as a way to replace my income. And I was just so excited. I was sharing the news with everyone I knew. And fast forward, I ended up building a company around it. I ended up becoming an operator myself. And it really is so rewarding when we can match investors to the right investments. And so that's what today is all about. How to find what type of investments right for you, how to find those, evaluate them, and jump into them. All right. So, oops. I'm just going to skip over some of these. So I'm going to start with how to determine what kind of investing is right for you. Because like I said, we're going to talk about 5 today, and they're all going to be a little bit different, right? So for you, before you get, all excited, like, oh, which one should I do in 2023? How should I set up my portfolio? I have 4 steps that I take investors through before you even start looking at investments. Figure out these 4 steps for yourself, write them down. So think about your vision first. So what kind of passive income do you need, or do you have net worth goals? Really, what is your vision? What's the purpose of investing, right? So we're all here, we're all learning in order to take action, in order to change our life. We're not here just to waste an hour and a half of our time. So you have a vision, you have a reason you're investing. So be really clear about it with yourself. Is it to build up a nest egg for your retirement 20 years from now? Or is it to replace your income starting next year or maybe this year? Knowing that will help you decide what kind of investing is right for you, because you will invest differently if you are those 2 different people with those 2 different goals. And really think about the level of effort you want to put into your investments. So I believe everything Dave's going to talk about are completely passive investments, and that's what I do as well. Some people really like to be hands-on with their investments, and there are, I'll briefly touch on them, but there are investments that you can get higher returns for, but you're also getting a return on your time. You're putting time into it. So be clear with yourself about that. And then think about the level of risk that's palatable to you. So maybe you're completely conservative, you are totally risk averse. Some of the things we're going to talk about are going to be perfect for you because they're very predictable, they're very steady, they're very consistent. Some of you are like, that's kind of boring. I want something more exciting. So I got something for you too. Maybe you're like, I'm really early in my career. I'm going to be working for a long time. I am really excited about some high growth opportunities, but they may be riskier. So we'll touch on those. And then set the goal. So this kind of goes with the vision, but be really clear about your financial goals and when you need them, because that's going to help you build an investment plan for 2023 and how to, dissect your portfolio. So maybe 80% in the risk averse conservative investments, maybe 20% in some high yield riskier investments, or it's going to be something else for each person. So at the end of today, I encourage you to think about what we've said, write it down, tell someone that you make your investment decisions with, and take action. All right, this is a disclaimer, and I'll cover it for Dave and myself because we might say some numbers, opinions, returns, etc. And this is educational only. We're not pitching investments to you. We're not making any offers to you. We're not selling securities in this webinar. So this is just saying, hey, there's risks associated with investing, including principal loss. So do your homework on everything. Okay, so Dave will dive in deeper to this, but when you look at different types of investments, I'm going to hit on 15 types of real estate investments that I've either invested in or been, kind of a lead GP on over the last 10 years. And the way that we evaluate them is when we're trying to, decide what to put in our portfolio. Some investments have high annual ROI, meaning at the end, when you exit, you get large capital gains, you have a large number. Some have high cash flow, meaning every month or every quarter you get a check, but on the back end, you don't get anything. So knowing when you're looking at marketing packages, when you're listening to, we're going to talk about the rest of the day, make sure that when we're saying ROI, annualized returns, cash flow, that you understand what those are. So again, the annual ROI does not mean that every year you get that money. It means that when you exit this investment and you average your returns over that time period you were in that investment, what did it average out on an annualized basis? That would be an annualized return. And cash flow is what do you get in the form of a check, quarterly, monthly, well, ACH actually. Hardly anyone does checks anymore, but you get the idea. And also level of effort and risk, I already touched on that. And then this is really important, the money needed to get started, because a lot of private placements, they have a minimum investment. It might be 25K, it might be 50K, it might be 100K, it might be a random number like 56K or something like that, which I've seen with some investments. And there's a reason for that, but just make sure before you start diving in that whatever that number, look at that number for the investment so that you know that it's right for you, that you're comfortable with that before you start doing all your due diligence and your planning around that investment. And then pay attention to the hold period. So you guys said yes when I asked, have you been in private placements? Then and that when you invest in a private place, it's not public, it's not like a REIT, it's not like a stock. You can't decide to sell it tomorrow to get a down payment on your house. So if something says it's a 7-year hold or a 5-year hold, really, really pay attention to that and make sure you're comfortable with that hold period, because it means you don't have access to the principal you put into that investment. Okay, I'm going to speed through this because Dave's going to hit on a lot of this, but I want to introduce this concept to you that there are a lot of different types of investments out there, and they're going to have different annual ROI, different cash flow, different level of effort, different risk, different cash needed to start, different hold period. And so this is part of my research over the last 10 years and part of my due diligence on different types of investments so that when I build my investment portfolio for the long run, it's aligned with my goals. So I encourage you guys to do the same. Okay, so with that, I believe I will hand it over to you, Dave. I'm going to stop sharing and give you access. So then you can jump in and talk about what have you been doing over the last couple of years? How have they been? Okay, I'm trying to talk and click at the same time. There, I made you co-host so you can share. What are the strong investments? How did you get started? What kind of results have your investors seen and all that kind of great stuff? We're really excited to hear. So I'll let you take over now. Thank you.
All right. Thank you, Sarah. Let me see here. Do you have my presentation up or do you want me to grab it?
You can grab it. Yeah, I'll let you drive for while you're talking.
All right. Let me go there. Give me a second.
Okay. Cool. Someone's asking, sure. Let me, someone say, can I? Actually, you'll have to grab it from the recording. The person who's asking, can I share out that last slide? So it's great. So I just want to say on that last slide, it is a point in time. So there were a lot of numbers on it. You can watch the replay and do a screen capture if you want. But know that that's a point in time. Things change. So we used to see cash flow of 8% on multifamily. Now we might be seeing 6% cash flow on multifamily. So know that it's changing. So what was on that slide is not evergreen. It was a point in time and example. So if you're building out that for yourself, know what the current numbers are in the markets that you're going into, because those numbers are also going to be different depending on if you're investing in California or you're investing in Huntsville, Alabama. So know that they do change. All right, there we go. All right, thanks, Dave.
All right, now, give me just a second here. Okay, you see my screen?
Perfect.
All right. So yeah, I'm excited to share. I was looking forward to that. I always look forward to feedback from folks and having these conversations with successful investors who are in the space and investing in different asset classes. So I'm looking forward to this. So thanks for putting this on. So I got this quote that I came up with a couple of years ago and trademarked. You can be conventional or you can be wealthy, pick one. And so I'm very comfortable talking about that with this crowd because I think everybody on this platform would agree. Few people, if you were the conventional type, you probably wouldn't be investing your time and energy on a Wednesday, Thursday afternoon. So I just believe this, and we're going to talk about some non-conventional stuff as we go throughout this presentation. So I had my past, and I'm going to talk a little bit about where I came from, why I got into the space. I'm going to talk about tax specifically because it's all going to come back around when we talk about asset classes. Because as Sarah knows, I entered this kind of investment world in a bigger way, just simply because I was a tax slave. I had built a couple of businesses and they got to be pretty successful, and got myself in a position where I was paying $500,000 a year in tax more than a decade ago. And so I really, when I got out from under that tax burden, I felt like I had been set free. And so that's why I'm so passionate about this stuff, is because I know there's lots of successful business people in my community and throughout the country who are very good at what they do, but they have very little understanding. A lot of people have very little understanding that you don't have to pay a lot of tax if you want to make. The conventional thinking is if you make a lot of money, you got to pay a lot of tax, right? And so I realized that I had been set free, and there's so many other people out there with the same problem, and I love helping people get set free from their tax liability. Couple of the sort of quotes that changed my life. Here's one of them. I started doing a deep dive. You know how they say when you're in, having extreme pleasure or extreme pain, that's when you kind of learn the most. And for me, I was in extreme pain, and I was in full blown learning mode. I mean, I was reading stuff. I was going to webinars, live events, and so Robert Kiyosaki made this statement that drove me absolutely crazy. You can make millions of dollars per year and pay no tax. I had to find out what he was talking about, so I hunted him down and got around him, got around his CPA. His CPA, basically gave me a quote that changed my life. He said, if you want to change your tax, you got to change your facts. And it was the first time in my life that I realized that it was in my control. I was in control of my own destiny. And I thought that I was a victim of I was a victim of the system, or a victim of, whatever, legislation, or I thought it was up to whoever was in Congress or Senate or whoever's making the rules. I just thought I was a victim of, and I had to deal with, it was just the life I was going to have to live. And even, my peers at that time, they were all of that same, kind of thinking. It was make a lot of money, you got to pay a lot of tax. And when I figured out that wasn't true, that's when my life changed. And so,
if you don't mind, I have a funny story about that, Dave. A friend of mine said that he was at the country club he belongs to, and people were sitting around bragging about how much tax they were paying, because then it showed how much income they had. And he was a real estate investor with Zook Capital, and he was like, it's the wrong thing to brag about, guys.
yeah.
But yeah, a lot of people don't
know. Paying taxes, many people, think it's our patriotic duty. And, what's the first thing that people think about when they hear about somebody not paying taxes? It's, tax cheat or tax evasion or criminal, or, oh, he's going to end up in jail. And well, let me just say this. I just came through a full-blown federal audit last year, first time in my life. And, we passed with flying colors based on what we all had going on. We did forget to turn in one K1. I know we had about a $20,000 gain. I ended up paying, $4,000 in tax and a little small fine and a penalty, late fee and a penalty, whatever. So, this stuff is legal. It's clean. You can do this. And I will also tell you that, in my opinion, when you get a tax bill, that's basically just a fine from the government punishing you for not doing what they want you to do, right? So paying taxes is not patriotic. If you want to serve your country, you don't want to pay any taxes, because that's just simply the government saying, thank you, you're doing exactly what we want you to do. And because you did that, we're going to give you nice, big, fat, juicy tax breaks. Good boy. Go do some more of it next year. Let's keep this guy. Let's put this guy to work and reward him for what he's done for us. So, how do you do that? You help your government out. You provide jobs. You provide housing. You provide solutions to their problems. Look, the government, the U.S. government, doesn't have to look very far into other countries and realize and see what happens when the state takes over control and tries to run, an oil program or a gas program or commodities or mining or whatever. And even in the United States, where they take over, housing projects. Look at the housing projects in this country, and when you realize, none of them are being run profitably like the kind that you and your partners run, Sarah. This is kind of a joke. The government is not good at running companies, and so they are happy to reward folks like myself and Sarah to go out and do these things. And I've seen the names on the list that are here with us today. And I know there's many people out there doing exactly that same thing. They're going out and providing solutions and problems and providing housing and all that stuff. So you guys are part of this club. Know the rules and play by them. Use the rules to your advantage. it doesn't matter who's in, okay, it does matter who's in the White House, but at the end of the day, the rules that come out, there will always be opportunity. You just need to know the rules. You might have to adjust your strategy. You might have to, once you get that framework, that set of rules, you might have to adjust your strategy and go do business differently than you did last year or 2 years ago. But know the rules. Make sure your team, your CPA, your team around you knows the rules and helps you implement and strategize and all that. So, stimulate the economy and impact your community. That's how you can be an asset to your family, your community, your country. All right. There are so many different ways to offset your tax liability that there's no reason for an able-bodied entrepreneur investor to ever pay a lot of tax. You got bonus depreciation, you got cost segregation studies, you could be a real estate professional, you got captive insurance, you got Section 469 that lets you take the tax deductions from oil and gas to offset the tax liability on your ordinary income. You got 453A, which allows you to defer your capital gains tax. You got R&D tax credits, which are some of the most aggressive, tax treatment in the country is R&D tax credits. If you're running a business and you're eligible for some of these R&D tax credits, I would encourage you to at least check. Maybe you're not. Maybe you are, but at least check and make sure that, if you can take advantage of some of these, take advantage of them. Because I can tell you, when you live a tax efficient life, it is the difference. Okay, so when you live the tax efficient life and you're trying to build wealth, it's like the difference of you being dropped in the middle of a river and you're trying to swim upstream, or you use the tax incentives and align yourself with what the government wants. You use those tax incentives and use them to your advantage and live the tax efficient life. It's like you turning around and swimming with the current, right? So check this stuff out and see if they apply, see how they can apply to you and how you can put those things to work. I taught a session, I taught part of this at the New Orleans Investment Conference where, I really taught people how to look at their different tax liabilities and see, really at the end of the day, this is like putting a puzzle together, right? So you got sort of 6 different kinds of income, and we're going to break it down to even more of the common ones, but you got passive income, you got capital gains, you got ordinary income, you got portfolio income, you got short-term capital gains, you got long-term capital gains. Let me just say, one of the reasons that I like to invest in real assets and not into, let's pick on the portfolio income. You would think that if you would get on your computer and buy a share of Apple stock, that'd be pretty passive, right? All you did was click the mouse. And then 10 years later, you sold that Apple stock for, 3 times, 300% profit or whatever. And then you clicked sell. You would think that would be pretty passive, right? Not so much. So they will not allow you to take depreciation, regular passive depreciation, passive loss of paper loss of depreciation, offset the tax liability on that gain. So that's one of the things that we don't like about investing in the stock market. So, there's different things that have to do with those different incomes that you need to be aware of so that you can put your game plan together. So let's narrow that down a little bit. So, kind of the top 3 that we think of most of the time is ordinary income, passive income, capital gains, right? And even within the capital gains, you can say, well, I got capital gains, it's 20% tax rate. Okay, well, is it passive income or ordinary income? Where do your capital gains come from? So just things that you need to know. And so we're going to jump in now to, sort of my top 5. And then Sarah, I'm looking forward to seeing some yours as well. But, I cheated a little bit because you'll see I took commodities because, there were several that fit into that category, but I took commodities and just called that one. So our core assets, as many of you know, over at the Real Asset Investor, are self-storage, car washes, and ATMs. And there's reasons for that, which we'll talk about later, I'm sure. Um, but commodities, I believe we're in a big, we're in the front end of a commodities super cycle. I started investing in natural gas about 4 or 5 years ago. I was a little bit early. I saw what was happening. I saw the infrastructure being built around our shipping terminals and ports. I saw the price the price that the spot price that those commodities were trading for in the international markets. And I thought to myself, okay, so we're trading at $1.50. Let's just say natural gas. We're trading at $1.50 per MCF. They're getting $40 or $50 overseas, and I know that the cost to ship is pennies, not pennies, but it's like nowhere near the arbitrage. Maybe $1 or $2 or $3 per MCF, whatever that cost is. And I knew that the disparity there was a real, potential to profit from it. So I started investing, and there was times when we actually shut our wells in because it was, we were only fulfilling our hedge positions, and we couldn't make money on anything that wasn't hedged. That was not a fun time to be in the natural gas space. So I was investing based on my conviction, not based on the returns on the investment that I was making at the time, because it was painful. But as many of you know, and some of you have been watching the natural gas space and what it's been up to in the last year or two, and those positions now are a ton of fun. I mean, you're talking, I know many investors in today's space or in today's climate, in today's, investment climate, that would be happy to make a 10% return. I mean, so there's a lot of stock portfolios that are down 20%. They'd be happy with a 10% return annualized. We're making 10% returns on a monthly basis on some of these positions that we took a couple of years ago in the natural gas space. So I believe we're on the front edge of that. I put in there natural gas, I put in there oil, and then the last three I want to break down and talk a little bit more about that because I think it's important to understand. There was a bill passed a couple months ago called the Inflation Reduction Act. And, you guys that have been hit by inflation at the grocery store, or to, pretty much everywhere you go, any retail outlet, you'll see, I get sticker shock. I'm like, oh my goodness, that used to cost, $10. Now it's like 15. And so don't worry, they signed the Inflation Reduction Act, so we should be back all good. Everything should be back to normal here just shortly, because they signed the bill. Okay, I'm kidding. I don't believe that. But
I disagree with that, but
I will say this. Every time there is a big bill like that's passed, and it doesn't matter if you like it or not, it doesn't matter if it's toxic, and most of the time it is. And this one is no different. It is, but there's opportunity within that bill. And so our job as investors and entrepreneurs is to find out, okay, what's in that bill. And so we did a deep dive, and we kind of, I got with my CPA, and we kind of tore this thing apart and summarized what's in the bill. What's in the bill that matters to me as an investor. And what we found was there's a lot of incentives in there that have to do with solar, nuclear energy, renewable energy, things that sort of support the electric vehicle push. But just being aware of what's in there, and then asking the question, okay, now where's the opportunity? Yeah, I don't like it. Yeah, the thing's toxic, but there's opportunity in there. And so being able to uncover that opportunity and just realizing, okay, if I switch my business model and I put myself in front of that space, because there's hundreds of billions of dollars coming into that space. So your job as an investor can be asking the question, okay, how do I get in front of that? How do I get in the front of the wave? Because I see myself in a situation like that. I see myself, I see just watch a surfing video of a guy getting up on a surfboard and getting pushed by the wave. He's just riding that wave. That's what you're doing when you're getting in front, when you're getting into some of these investments and getting in front of that wave, because there's $400 billion going to get, there's a $400 billion wave coming at you. So there's opportunity there. I will tell you this. We own, in the last 2 years, we've purchased over around 30,000 acres of land. And a lot of it had to do with timber. A lot of it had to do with the opportunity we saw in the timber market. The timber market acted a lot like the natural gas market in the last few years. We've seen the timber market really go for a ride there for 12 to 18 months. It's cooled off a little bit lately, but we had a lot of fun in the timber market in the last few years. But what we've also figured out that some of this land had transmission lines on it. Some of this land was desirable for an institutional grade solar package. And so we were talking to solar groups on 4 different tracts of land. And some of it, they were coming back saying, this will work, this fits, and we actually signed a contract with one of them. And so we were going through this process, and they were like, well, this guy kind of got shelved. This is probably a 2025 or 2026 deal for us. It's not real, top of mind for us. What was interesting, very soon after the Inflation Reduction Act got passed, we've got solar contracts with green lights. They're like, oh yeah, we got 4 total solar contracts in hand with non-refundable deposits. And they want to tie up this ground, and some of these projects got green lighted. They're like, let's go. So there's just an example of getting in front of the wave. So lots of opportunity in this space. The other one, many people have different thoughts on this one, and I respect that. But you've seen what happened with Bitcoin and cryptocurrency in the last year or two. I would just tell you that despite what just happened in the last year and a half, just don't write it off yet. One of the things that is very encouraging to me, and sort of some of the things that I think about when I make decision on a certain asset class like Bitcoin, is what are the institutional players doing? So you see big banks, you see pension funds, you see retirement funds, you see Fidelity, Magellan, you see some of the biggest banks in the world setting up trading desks and getting involved, getting themselves set up to play the game. And you got to ask yourself, it really doesn't matter what I think. It matters, are these, biggest entities, biggest players in the world getting into this space? Do you really believe this is not going to go anywhere? Just think about that for a second. So, it doesn't matter what you think or how you feel about Bitcoin. It should be on your radar. I'm not saying go out and buy a whole bunch, but it should be on your radar. And so those are sort of my top 5: ATMs, car washes, self-storage, Bitcoin, commodities. So, Sarah, I would love to hear from you, and I'm happy to keep going. I'm happy to break down why I like some more of these asset classes. I talked about commodities. I talked about Bitcoin. Car washes, self-storage, and ATMs. I mean, we could make a whole webinar series out of each one of those asset classes.
We
So
could.
I don't want to hog this whole thing, but I'm happy to go deeper if you want. So back to you. We can go,
Yeah.
we can go wherever you want to go with it.
I'd love to leave this up because I am quite aligned on a few of these, and I'd love you to expand on car wash because that's not on my radar. But I'll comment on my opinion of all these because they're quite similar. So for the commodities, like you mentioned in the previous slide around tax, one of the reasons that we invested heavily in the oil and gas, forget what part of the tax code is, but we can use those investments to offset the income of my husband's W-2 job. And so that's unlike, our real estate investments can't do that. But the oil and gas investments can offset W-2 income tax. So we made a bunch of investments in that space for that reason. And the returns, we haven't been getting 10% per month, but they're comparable to the self-storage, the multifamily. So when you take into account that they can offset W-2 income tax, then it makes them really, really nice. So I definitely agree with that space. And definitely, I love what you said about getting ahead. I did a podcast last night, and that is all we talked about is getting ahead, taking a look at the bigger picture, not just what is a good investment today, January 2023, but what's going on in the future, 1 year out, 5 years out. Do a SWOT analysis on the type of investments you're looking to do and see what could be changing in that space, both world economics, local government, federal government, all those things are really important to pay attention to. And, the renewable energy and nuclear energy, I really like those, not necessarily from a lucrative position, but because we're going to have to get there someday on those things. So I love investing in them because I hope that they will make the planet a better place for my grandkids. On the self-storage, I love self-storage. I always say this to my investors that if you love multifamily, you probably will also love self-storage for the same reasons. It's very recession resistant. It's a, what's it called, an imperfect commodity, or when the economy is great, it booms. When the economy shrinks, it booms. And that you're in the space. I don't operate any self-storage units. I never offer them, but I always tell investors like, hey, if you like the stability, the predictability of multifamily, which is our bread and butter at Zook Capital, then you'll also like self-storage. It provides really similar returns as far as some cash flow and appreciation on the back end. And they're really low risk. You don't have high turnover. We moved into a storage unit when we moved back from Europe 2 years ago. What's in that storage unit? I don't know. We still have it 2 years later. And it's one of those things that the turnover is just so low. And so they're really predictable. And especially when, people are like, is there a recession or is there an expansion coming? In both of those scenarios, self-storage is a strong investment. Now you talked about crypto. And I think this is really interesting because about a year ago, I was like, crypto, it's so volatile. I like multifamily where it's, safe, predictable, risk-free. It's not volatile. It's great. And so crypto is like the opposite. It's like the antithesis to me. But what we started doing was saying, okay, it is the opposite end of the spectrum on as far as volatility. However, if you use the volatility to profit, so scalping and trading on anything that's volatile, we've been doing that over the last 12 months. And so what we're expanding into, Zook Capital is expanding into this year, are funds that are not buy and hold in the crypto space or in the security space, but more, hey, what's really, really volatile? And let's jump in and play with that volatility in order to capitalize on it and make a profit. So it's in, it's out, you make a profit. It's trading, it's really, really lucrative. So like you said, the 10% that you were seeing in some of your oil investments, so we're seeing 20-25% per month with this model. And so now I'm like, yeah, now I think it's great, but only because of the volatility. So you can do this with anything that is really volatile. And that goes back to also paying attention to, it's not going to be 90% of your portfolio, but maybe a portion of your portfolio, you can go into these categories where they're riskier, but really, really lucrative on the returns. Now, there's not really a tax advantage. So there's that piece of it. It doesn't play into that part of your tax strategy. But we'll see in the future. It may, who knows? It's new enough. We'll see what happens. But I also agree with you, Dave, that it's not going to go away. I mean, we see who's adopting it. One thing that I am a bit paying attention to and a little bit nervous about, you could say, is bringing crypto, blockchain, tokenization into the real estate space. And so a lot of people are like, hey, that's really cool because it solves the problem of liquidity for investors. You know, like your self-storage investments, 5-year hold, you can't come in and out, your 100Ks in there for 5 years. And so putting those investments on the blockchain introduces liquidity. So that's like, hey, yay, we solved a problem. But then it introduces a problem of volatility as well. So I'm curious to see how that will balance out and affect the market when we're talking about, syndications and fund structures. So similar to, how the REITs that people were doing a run on the REITs and the big REITs and the big funds were like, hey, we're gonna say no more taking your money out because it's really going to affect the market. So those sort of things are also things to pay attention to for the long run and think about what are all the downstream effects, because, like you joked about politicians saying, hey, we're going to fix this problem with this act or this measure. But then they don't think about, okay, but now you created these 20 other problems. And so I think in the crypto blockchain tokenization space, it's important for us to think about, okay, solving one problem, what problems might it introduce, and how can we be prepared as investors for how that will change the investment market. ATMs, I love ATMs. We're invested in those for the high cash flow. And, they're very predictable. It's the same amount of money gets deposited to my account every month. And so it creates a really steady return for our investors as far as cash flow, and the depreciation is great. So I really like that. I'm not an operator of those type of funds. Dave is, that's his jam. So if that's attractive to you, Dave's the one. And then car wash, I don't invest in. So I'd love to hear you talk more about that, but I'll say my fifth one in this space would be multifamily. Similar to why I said I love self-storage. And that's because it is very recession resistant. It's very predictable. It does have some, it does fluctuate, but it doesn't fluctuate the way single family housing market is fluctuating. It doesn't respond very quickly because it can often take 6 months to close on a property, at least 60 days. So it doesn't have, because it's not liquid, because you can't buy and sell quickly, then it has more stability. So that's what I really like about multifamily and commercial in general. And the way things are changing in certain markets as far as, the preference of the newer generation and the older generation to be more flexible in where they live. So you can watch for the emerging markets, see who's moving there, see what the housing is, see if there's a supply and demand constraint. And like you talked about earlier, how can we supply a solution to a market that has more demand than it has supply for housing, for new jobs, for new workers coming in? And so that's where we'll go into those markets, have a solution, provide housing for the new jobs that are coming in, whether it's new development or fixing up an old apartment building. That's what we love to do. So that would be my addition to what you have up here. But yeah, I'd love to, do you want to expand on car wash and why you think that is lucrative even when there might be shifts or unknowns in the market?
Yeah, so we set out to fulfill a demand that we saw in the marketplace. So one of my operations partners had been on the private equity side of Wall Street, packaging deals together, and he was very aware of what's going on in the private equity markets. And the opportunity in this space is to, well, first, the largest player, we talk about self-storage being fragmented with a lot of mom and pop owners. Well, the largest player in the car wash space only accounts for about 5% of the revenue. And so Mr. Car Wash went public about a year and a half ago. They're the biggest player in the space, only have 5% of the really market share of the revenue coming from the space. So what that means is it's hard for institutions and private equity to come in and take a sizable position in the space. They can't cut $100 million check because nobody owns $100 million. Very few people own $100 million worth of assets in the car wash space. And so what we've seen is the last 4 car wash portfolios of 20 or more, well-run portfolio of 20 or more tunnel washes have traded around a 20x multiple. And so we saw that and we're like, well, that makes a lot of sense. The other thing that happens is private equity doesn't have the patience to sit and wait and develop these car washes. So we're doing it for them. I've been in the car wash space now going on 3 years, and we've got 8 operational sites. We've got 4 more coming out of the ground right now. Next quarter, I think we got 11 more coming out of the ground next quarter. So the target when we got into this space was to build 30 to 50 in 4 to 5 years. We updated that target to now between 60 and 70 in 3 to 4 years. And so, what we're planning to do is build this portfolio for an exit and capture that multiple. What we would love to do is, build a business that we would hate to sell, but that we would be crazy not to, because they are paying a premium for them right now. So what we did is we built the model very similar to the ATM model, where the investors get the cash flow, in this case, 100% of the cash flow until they hit their multiple, until they hit their 1.75x, or invest $100,000, get 175 back. If that portfolio sells in 3 years, 4 years, 5 years, we projected out 5, based on a 5-year hold. But if that portfolio sells in 3 or 4 years, the investor's IRR goes from 22% to through the roof. Because you're making the same amount of money in a much shorter period of time. So we set up the business model like that. But what we really like about the car wash, and it's similar in this way to the self-storage and ATM space, it's very recession resistant. During between 2008 and 2010, I always like to look back and say, okay, how did this perform back in 2008 to 2010?
Yeah, 100%.
How did it perform in 2020 and 2021, 2022. And so when we look back at those times, car washes, the revenue dropped around 8%. When you realize that our operating margins are between 45 and 50%, 8%, you can handle that. You'll be okay. The other thing that we recognized is, and you talked about it with your self-storage space, the pain isn't great enough. The pain isn't great enough for you to drive across town, clean out your stuff, get your stuff out of that, whatever, 10 by 10 box or whatever it is. And, it is maybe only costing you $100, $150 a month, $200 a month, whatever it is. Well, it's the same way with a car wash. Are you really going to drive a dirty car for $20 a month? And you can get into this subscription, the base model, and this subscription model is $20 a month. And so, the pain isn't great enough to not do it. And so the other thing that we really like about the business model is when you recognize how Wall Street or private equity firms, institutions look at this business, they love the subscription model. Look no further than Netflix or some of the subscription-based companies, it didn't matter when they were given their earnings report if they lost $100 million. What mattered is they took their subscribers from, 1 million subscribers to 1.3 million. And so that's what they look at. And I'll give you a quick example, and then I'll turn it back over to you, Sarah. We bought an existing, most of what we're doing in our car wash fund is we're building car washes, we're developing car washes, building them brand new. But we have bought several fully operational sites. We bought one of what had been one of the top 10 sites in the country, Tommy's Car Washes. And our team gets in there. We quickly brought it up to number 3 in the country. But what we realized when we did that is we took that subscriber base and really got that to the bottom. I mean, we grew that subscriber base by more than 30% in less than 4 months. And so what we did is we took that value. Not only does the value come down to your bottom line because you have your fixed costs and all, but when you put that monthly income in there with, several thousand new subscribers, what happens is Wall Street puts a value on that based on your subscription model, based on the recurring revenue. And we actually increased the value of that location by $6 million in just 3 or 4 months. And that's not even considering the cash flow that we get to enjoy throughout that whole process. That's just the valuation that happened in that one site in about 4 months.
So you have some private equity investors. Is it also open to retail investors?
Yeah. So we plan to exit to private equity and to an institution. So most of our investors, I mean, we do deal with some family offices, but most of our investors are private individuals.
Awesome, because I saw people asking it in the chat. So awesome, cool. Well, I love it. I want to ask everyone, since these are all and plus multifamily, these are all private investments. Well, crypto now, but do you guys, a lot of you have invested in these type of investments. So I wanted to next talk about the structure of these investments, whether they're funds or syndications as a model. Would that be useful for you guys? Is there anyone who would like to see the structure of these type of investments as far as how the equity and the cash flow and the ownership plays out? Now, the numbers would be different for every deal, but there's kind of a general model I can show you guys. Okay, I had some yeses. Cool. I will go ahead and stop your sharing, and I will take back over, and I will go ahead and share my screen. So again, Dave talked about some of the, oops, didn't mean to share, I meant to slideshow it. Talked about a couple of the investments that are on here. And what we do at Zook Capital mostly is apartment syndications. And so I'm going to talk about the structure of an apartment syndication, but know that it's a really similar structure for funds, for the storage unit, for natural gas, for private placement. So just replace apartment building with whatever the investment is. Okay. So say we want to buy this apartment building. Again, you could substitute a storage unit building in here. These are totally fake numbers. This is not a real offering. This is just an example. So say it's for sale. We want to buy it for $1 million. Well, that would be a steal. I wouldn't take any investor money. I would just buy it myself because I'd make a killing on this building for $1 million. But anyway, so what we do is we get a loan for, say it's 70%, and then we need a down payment of 30%, and there's some closing costs. So what we do is we go out to investors like all of you who are on this webinar right now, and we say, hey, we have an investment opportunity. Would you like to invest? Here's some typical returns. And you may say, well, how does that work? How do you get those returns for me? Okay, so we have a couple people in the deal. So you'll see that at the bottom. There's the general partners. So that's like Dave, that's like myself. They're the operator or the fund managers of the investment. They are the active investors in the investment. And then there's limited partners who would be considered the passive investors in the investment. So folks like you who are on here. And then gray in this pie chart I'm going to show you represents debt or loan. So for the, we have to make this purchase. So where does the money come from? Where does the capital come from? So if this pie represents all of the capital to make this purchase, let's say we get a loan for a piece of it, the general partners will supply a piece of it, and then passive investors supply a piece of the capital. Okay, that's great. So we go out and we say, hey, you guys want to jump on in? We get 300,000, we make the purchase. Then how do we assign equity? So how does ownership play out? Well, it's not that everyone is directly on the ownership for this apartment building, and it's not like everyone is direct ownership on the storage units. And when you go into, say, nuclear energy development fund, you don't have direct ownership of those assets. What happens is there's an LLC that's created, and that LLC owns the asset that you're investing into. And so how does that LLC ownership get split up? This is how it gets split up. So again, the numbers are going to be different, but this is, usually what you can expect to see is something around these numbers. So the general partners or the active investors, the operators, the fund managers, etc., they would often keep 30, maybe 35, maybe 25% ownership of the LLC that holds this apartment building. Then the limited partners, the passive investors, you guys, would get 70% ownership of the apartment building. So this is really important to understand, because when you're looking through PPMs and offerings, you're going to want to understand the balance of these two eyes in the investment you're going into. And this is why you are able to get the returns that are projected for that investment, because you can see the two green pieces of pie are not equal. So it's not like, well, for providing 30% of the purchase price, you get 30% ownership. It's not how it works. For providing 30% of the purchase price, you get 70% ownership. That is more than 2 times the percent. And so this is how, when the cash flow comes down, if you as the passive investors get 70% of the cash flow coming in for that business, that apartment building, you get 70% of the capital gains at exit. When the apartment building is sold, or the storage unit is sold, or anything else that's sold, the car washes. And so this structure is really the basis of how all the private investments work. And again, the numbers will be different for each one, but I want to see if anybody has questions on this, because this is the basis for private investments, and you're going to want to take a look at. Any questions on this before I move on to the next slide? Isn't that net cash flow? I'm not sure what you mean, Stephen. Anyone else have questions? All right. Oh, any Q&A? Oh, yes. We'll hit on this later, Ed. I will take your question later. That's a good one. Okay, so terminology. When you're looking at the different types of investments that we've been talking about today, you're going to see estimates for targeted cash-on-cash return. And you might see numbers like preferred returns, and know that those two numbers are different. So cash on cash, like the car wash, if you are, one of the LP investors and you get 70% ownership of the car wash, you would get, say, the marketing material says 8% cash on cash. That means over the course of the year, if you invest $1,000, you would get $8,000 that year in the form of cash flow. I don't know if it comes out monthly or quarterly, but you would want to pay attention to that as well before you invest. Make sure it's aligned with your goals. And then there's the targeted investor annualized return. So if you see 20%, and I'm going to show you on the next slide, you guys, how it plays out over the years. But if you see a targeted investor annualized return, like I mentioned earlier, that is not the amount you receive each year. It means when all things are said and done and the investment is sold, what do you get as an investor if you had averaged it over the hold period of the investment? And I'll show you how that plays out. Investment profile. So both Dave and I talked about value add and new development. So if he's building a car wash, it doesn't have any cash flow before it's built. Same with, we have some new development apartment buildings. New development will not have cash flow before it has the certificate of occupancy. So it might take 2 years before the cash flow starts. Now, value add means it's existing. So we buy an apartment building and right away we have tenants and it's going to cash flow. We're going to remodel it so it cash flows more, but it'll probably cash flow within Q2 or Q3 of ownership. And so if cash flow early on is important to you, you're going to want to make sure you are choosing a value add project. And, you know, we didn't really hit on this, but I hope everyone becomes familiar with your status as an accredited investor or not. So most funds are 506Cs, meaning they're for accredited investors only. We do have some multifamily syndications that investors can go directly into, not via the fund, and they're 506Bs, which means non-accredited investors are welcome to join. So what this means is your net worth is $1 million or more, makes you an accredited investor, or you have an annual income of 200K or more, or 300K or more as a household. So if one of those things apply to you, then you're an accredited investor. So most investments will be open to you. And if not, then that means get to know someone who has 506B offerings, which means they're open to non-accredited investors, which we do have those as well. Targeted investment period. So you heard me talk about this a lot because I'm very passionate about making sure investors know this, pay attention to it, and are very comfortable, because it breaks my heart when I've had investors say, hey, you know, I've been in there 2 years. Can I just sell my ownership to my friend because I want that money for a down payment? And although with some legal work and accounting work, things are possible, but you should just not expect that it's going to be liquid when you're in a private placement that says the whole period is 5 years. Unless they say, oh, at year 2, we're going to do a cash out refinance and you'll get 50% of principal returned or whatever it is. And again, minimum investment, make sure it's aligned with how much you're comfortable investing in that. Okay, so if you take the investment on the previous page with that terminology, like how does it actually play out for you? This is going to be important to understand this chart so that when you go look at offerings from Dave or myself and we have those numbers, you know when the money is coming into you. So we're going to use an example of 100K and the information on the slide ahead. So it was a 5-year hold. So I played this out for 5 years and it was an 8% cash flow investment. In the example, 8%. So that means if it says 8% cash flow, it's assuming, okay, every year you get 8%. So on your 100K, 8,000 a year. It's not amazing. It's better than negative 20%. That's for sure. Like a lot of people's portfolios did. However, the big kicker on most of these projects is when the sale happens. So you can see this next column, proceeds from sale. So when we sell the project, when we sell the investment, say in this example, proceeds from sale, 60K. So that's the capital gains for the investor. So there's an overall profit in the sale. Investors get 70% broken down to each investor. Say this investor gets 60K. So that means, and then you get your principal investment return. Now this is important to know as well, because not all investments provide principal investment at the end. So make sure you understand that for your investment that you're making and that you're comfortable with whether it does or doesn't. Neither way is bad. It just, you need to know it before you make the investment. And a lot of people miss that. Okay, so you get your 60K from the sale. You have your 40K from your yearly cash flow over the 5 years. So if you add that all up and your principal returns, you've turned your 100K into 200K. And this is a passive investment. So you have turned your 100K into 200K over 5 years without doing anything. Now, Dave also talked about the tax advantages. So I didn't put tax in here because it depends on the investment. You can see 30 to 100% bonus depreciation on a lot of the investments we've talked about today. And so that means that you wouldn't have to pay tax on some or all of the income from this investment. And I'm not a tax professional, so I'm not going to go into it, but I wanted to show you what it looked like if you didn't pay taxes, because it is possible that you invest in a way that you don't have to pay taxes on it. So that's the structure that I wanted to share with you guys so that when you see these numbers and these terms, you are comfortable and familiar with it. So, okay, so I see a bunch of questions. So any questions on the structure and the terminology that I said, and then we'll wrap it up and just go straight to Q&A. Any questions on this? Cool. I hope it's really clear. So my goal with doing all these, I didn't mention this. This is the first in a 2-month series. So every Thursday for the next 2 months, we're doing webinars with guest speakers talking about investing and different nuances around portfolio management and that sort of thing. So it's really important. That's why we started off with Dave and this information, because it's important to know it before you move on and start making decisions. Yes, I'll show the terminology slide again and just back up with all the animation. Here's a different terminology, and I don't have preferred return on here, but so you know, preferred return, if you see that, it means that investors get that number before the GP side gets any returns. So if it says 8% preferred return, it means investors will get an 8% return before folks like Dave and I start getting any return on the investment. Oh yes, Vonda, very good question. What would be the equity multiple on this deal? Can anyone else in the audience say what would be the equity multiple on this fictitious example? 2x, perfect, yes. So 2x over 5 years equals 20% per year. So it's 100% increase over 5 years. So if you annualized it, it would be 20% per year. So when you see those numbers in the marketing material, it's a 20% annualized. This would be an example of 20% annualized. You don't get 20% per year, but if you take the fact that you doubled your money in 5 years, you divide it by 5 years, it would be 20% per year. All right, cool. No, it is not IRR. It is not IRR. So this would just be the straight annualized return. Good question, Vonda. Cool. All right, so I think that's the end of the material that I wanted to share. Oh, I do want to, now before, in case people have to jump off, Dave, I want to share with everyone how to get in touch with each of us. So I'm just going to bring up mine, and then I'd like you to tell people what's the best way to get in touch with you and learn about your educational events and offerings. So for me, sarahs360.com. That's the best way to find out everything about me. It has my contact, my website, my events, my track record, my portfolio, anything you want to do to find out more about Sugo Capital is at sarahs360.com. And on there also, if you go to that, there's a little button that looks like a calendar and it says schedule. Yeah, it just says schedule. So when you click on that, it gives you the option to schedule a 4-point strategy call with me. So that's if you would like to, you know, at the very beginning, I said, hey, you know, I take investors through this. Last week I had my investor relations team say, I said, how many of these calls did I have in 2022? And there were 550 investors that I did this 4-point strategy call with in 2022. So we run through in that call these 4 things. We get really clear on what type of investing is right for you. And so if it's not multifamily and it's something that, you know, car wash, and I'll say, go to Dave. So we look at all different kinds of investment options and see what's best for you, given your goals, where you can find the money to invest. So, you know, you can invest in most of these with your IRA, your 401k, deferred sales trust, 1031 exchanges. You can use all of these, and so we'll talk about where you can find pockets of money. You might have the equity in real estate you can leverage. When is it good to use retirement funds? When is it not good to use retirement funds on different investments? We go through that. We'll do some financial modeling. I have templates and I just plug in your scenario so we can show you what kind of investment income you can generate. And then the last and most important thing is the next steps to implement your plan, which is connecting you to the investment options. So feel free to jump on to sarahs360.com. Again, there's a little calendar icon and it says schedule, and you can click that and you can book some time to go through this with me. And with that, I'll hand it over to Dave. And Dave, what is the best way for people to learn more about what you do, be in contact with your team if they want to get started investing with you.
Yeah, so our website is therealassetinvestor.com, and the best way to reach me or us is info@therealassetinvestor.com. The reason for that, like Sarah mentioned on the top of the call, I got a great team and we man that inbox. So if you send something in, if you send in a question, a comment, or whatever, you're going to get a response. So feel free to reach out to us.
Yeah, awesome. All right, so now we're going to open it up to Q&A. And the first one's for you, Dave. So Ed is asking, why didn't multifamily make it into Dave's top 5?
So I actually like multifamily. I had built up a portfolio of 3,000 to 4,000 doors, and I sold my last 286 unit multifamily apartment. I sold the last one in August of last year. I would expect at some point to get back into the space. I believe that asset prices today do not truly reflect yet what's going on in the marketplace, specifically interest rates. I hear it all the time. We deal in several different asset classes. Many of you had, got our self-storage webinar, I think yesterday or this morning. We just did one, but we talked about a little bit with our self-storage team. What's going on in the marketplace? And we're now seeing a reversal of that 10-year climb, 10-year plus climb of asset prices just in the self-storage space, just climbing for 10 years, and you've seen it in the multifamily space. This was a good time to be an investor in real assets. I believe that you're going to see the reality hitting some of the sellers, and you're going to see, Sarah, you mentioned this. I believe you mentioned the REITs locking up the liquidity so there couldn't be any redemptions. Well, you saw, BlackRock do that.
Yep.
And, BlackRock being one of the biggest, fund managers in the world. And so, there's pressure, and, there's some redemption going on. I'm having conversations with multifamily operators. There's some, institutional level guys, there's redemption pressure. And so I believe, based on what's going on in the marketplace, specifically interest rates, I believe the buying opportunity is going to be, better starting today and going forward. I'm looking at, 6 to 18 months than they have been in the last few years. So I don't not like multifamily apartments. I just feel like we're going to be in a better position as a buyer in the next 6 to 18 months than we are today and have been for the last couple of years.
Yeah, 100% I agree. And we closed on some in the last quarter of last year. And it wasn't even so much the interest rates, it was the amount that lenders would lend, the loan to value amounts changing like the day before closing, 2 days before closing, like, instead of 75%. Yeah.
Which means that all of a sudden you got to come up with a bunch more equity, right? I mean, we've seen the same thing in the self-storage space. LTVs went from 70, 75% to 60, 65%. That's a big deal when you're talking, a 10 to $15 million asset.
Yeah, exactly. We had a $40 million asset that happened to, and they're like, just come up with 6 million in the next 2 days.
Yeah.
Yeah, I took a 3-week break after last quarter. I was like, whew, that was there was so many fast changes at the very end.
Well, and it takes a while. I mean, just you gotta. I kind of look at it like you're driving a car 100 miles an hour over the cliff, right? And you clear the cliff. You don't just go like, this thing goes for a while, like, before it takes the. And I think we're in that period now, and I'm not calling for a full out recession or depression or any of that, but I think we're in that floating phase where sellers haven't come to the realization that that reality hasn't quite set in, and everybody has been used to their assets outperforming and appreciating, and sellers are going to have to take another look at things and come back to reality.
Yeah.
And they are, and there will be more, and I believe in the next 6 months or so.
Yeah, 100%. I think so. It's harder to find stuff, but when we find stuff, I think there's going to be those distressed sellers that we can help out, find a solution, take things off their hands. Yeah. There's a question from Ted, and I don't know the answer. Do you know, Dave, what's the best way to invest in farmland? I sold some that I inherited because I didn't want it.
So, it is a different kind of investment, and you just got to know and be okay with it. It's, for me, farmland, unless you can figure out, several different ways to monetize it, if you're just going to, do crop land or raise beef cattle or whatever, you're not going to get the kind of returns that Sarah showed you on the multifamily deal. You're not going to get the kind of cash flow returns, let me say. It can be, to me, investing in farmland is more of a capital preservation play. Yeah, you may get some income, or you may figure out 2, 3, 4 different ways to monetize it. That's the way you make money in farmland, in big chunks of land or farmland. But it depends on what you want as an investor. I mean, I've bought several large tracts of land in the last 2 or 3 years, to the tune of 30,000 plus acres. And, one of the things that's made that really successful for us is we've figured out how to monetize that real estate, not just in timber, but, timber, solar, turnkey, meaning, we've gone in and planted food plots and put up hunting blinds and after we've gotten the timber off, and then turned around and turn it into a turnkey hunting property or recreational property for somebody. That stuff can really work well when it's within 1.5 to 2 hours of a major MSA. And so really just knowing what you want as an investor, that's what it's about. You just got to figure that out on the way in.
100% agree. I see another question, Long. You're asking, can you 1031 exchange into these investments? And you cannot 1031 exchange into our fund. However, you can 1031 exchange directly into the syndications at the property level. So for instance, the 40 million apartment complex I was talking about that we closed in December, we have 4 investors who 1031 exchanged into that apartment complex with us, and we do a tick structure. So if you're thinking of doing that and you want to learn more, just send me an email along. We'll set up a time to talk about the size of your exchange, when it's happening, and what we can do to defer those taxes for you, because that's what we love doing, right, Dave?
Yeah, and we've done the same thing in our self-storage properties, exactly the same way. The investor takes doesn't take ownership in the fund, takes ownership in the property directly through a tick, like you just mentioned. So can be done. There's more, there's a little more paperwork. It's you gotta get a little creative, and we have a $1 million minimum for investors like that, just because of that. It's you got to get a little creative, and it's a little more work.
Yeah, and we have a minimum of 100K because of the way we set it up. It doesn't have a cost per individual investor, but we did have that $1 million threshold before. So yeah, throwing it out there. There are options for you guys. So if you're selling something, definitely talk to one of us and see if we have something lined up that would match your goals. Jesse is asking, what's the typical time period to receive first distribution on a build to rent investment? Depends on the size. If it's, a 300 unit apartment complex, it might be 2 years, might be 3 years. If it's, individual townhomes that are doing build to rent, that would happen much faster. So it depends. This one's for you, Dave. The first group of investors in Tommy's Car Wash, when do they start receiving distributions?
They have started last quarter, and so I believe this quarter will be their second. It will be their second payout. So we're on schedule with that. So the first group that came on with us, I think it was last November, December, got their first distribution last quarter.
Awesome. And I'll say on the ATM investment, I think we did 3 different ones. And the distribution started early on 2 of them, I think. So.
Yeah, so in the ATM space, normally when you invest in ATMs, there's a 4-month lag. You make the investment, and about 4 months later, you get your first distribution. At the end of the year, we strategically put a fund together that those ATMs are in place. They're fully operational, in place by 12/31. So what happens when you invest, in middle or late December, if there's inventory available and you make that investment that late into the year, your first distribution is on February 25th, because that ATM's in position. January, it's collecting revenue. February 25th, it gets paid out. So that's normally the only time that we have a less than 4-month lag time. That's right at the end of the year.
Yeah, that's what we did. Cool. All right. Well, I think this was great, and we can go ahead and wrap it up. And people who are asking for our contact info, we're going to send out a replay with the recording with all the ways to get in touch with Dave and myself. So you will be able to access the links that were posted, access links to our company's emails, etc. So we'll send that out tomorrow. You are a great audience, very interactive. I love everything that I was seeing in the chat. So thanks for being a lively audience for us. That makes it more fun for us to spend time up here with you guys. And Dave, thanks for explaining all the different ways, the options that you've been investing and that you see to be profitable investments for the next few years for this audience of really hungry, really engaged investors. So I appreciate it, and I look forward to the next time that we're on the stage together.
Thank you, Sarah. Thank you for your continued partnership, and thanks to the many people that were on a busy Thursday afternoon. So this was fun. I enjoyed hanging with you, and feel free to reach out to us anytime.
Definitely. All right. Have a wonderful rest of your day and week, everyone. Bye-bye.